I would say that, but look through book value would not mean much, actually. The very best businesses, the really wonderful businesses, require no book value. We want to buy businesses really that will deliver more and more cash and not need to retain cash, which is what builds up book value over time. Admittedly, the prices of marketable securities at any given time are not a great indication of their intrinsic value. They are far better, though, than the book value of those companies in indicating intrinsic value. Berkshire's intrinsic value, in a very general way, and trends in it are better reflected in book value than is the case at a very high percentage of companies. It's still it's not a great proxy. It's a proxy that is useful in terms of direction, in terms of degree, in a general way over time, but it's not a substitute for intrinsic value. In our case, when we started with Berkshire, intrinsic value was below book value. Our company was not worth book value in early 1965. You could not have sold the assets for that price that they were carried on the books. No one could make a calculation in terms of future cash flows that would indicate that those assets were worth their carrying value. Now it is true that our businesses are worth a great deal more than book value, and that's occurred gradually over time. So obviously there are a number of years when our intrinsic value grew greater than our book value to get where we are today. Book value is not a bad starting point in the case of Berkshire. It's far from the finishing point. It's no starting point at all of any kind in whether it's the Washington Post or Coca-Cola or Gillette. It's a factor we ignore. We do look at what a company is able to earn on invested assets and what it can earn on incremental invested assets, but the book value we do not give a thought to. And earnings are what determine value, not book value. Book value is not a factor we consider. Future earnings are a factor we consider, and as we mentioned earlier this morning, earnings have been poor for a great many Japanese companies. Now, if you think that the return on equity of Japanese business is going to increase dramatically, then you're going to make a lot of money. I mean, and you're correct, you're going to make a lot of money in Japanese stocks, but the return on equity for Japanese businesses has been quite low, and that makes a low price to book ratio very, very appropriate, because earnings are measured against book. And if a company's earning 5% on book value, I don't want to buy it at book value if I think it's going to keep earning 5% on book value. So a low price book ratio means nothing to us. It does not intrigue us. In fact, if anything, we are less likely to look at something that sells at a low relationship to book than something that sells at a high relationship to book, because the chances are we're looking at a poor business in the first case and a good business in the second case. Relative price earnings ratios move up because people expect either the industry or the company's prospects to be better relative to all other securities than they have been than their preceding view, and that can turn out to be justified or otherwise. Absolute price earnings ratios move up in respect to the earning power or the prospective earning power that is viewed by the investing public of future returns on equity, and also in response to changes in interest rates. And in the recent, ever since 1982, but accentuated in recent years, you've had decreasing interest rates pushing up stocks in aggregate, and you've had an increase in corporate profits. Return on equity of American businesses improved dramatically recently, and that also, and people are starting to believe it. So that has pushed up absolute price earnings ratios. And then within that universe of all stocks, when people get more enthusiastic about a specific business or a specific industry, they will push up the relative PE ratio for that stock or industry.
Yeah. Well, the intrinsic value of Berkshire, like any other business, is based on the future amount of cash that can be expected to be delivered by the business between now and Judgment Day, discounted back at the proper rate. Now, that's pretty nebulous. Another way of looking at it is to try and figure out the value of the businesses we own presently, and we try to give you the information that will enable you to make a reasonably close estimate as that. We own lots of marketable securities. It's probably safe to say that they are worth more or less what they are carried for. And then we own a number of operating businesses, and we try to give you the figures on those businesses that are the figures that we use in making our own judgments about the value of those businesses. Now that tells you what we have today and more or less what it's worth. But since Berkshire retains all of its earnings, it becomes very important to evaluate what will be done with those earnings over time. I mean, it is not only a question of what the present businesses are worth. It's a judgment on the efficiency or the effectiveness with which retained earnings will be used. If you had looked at the intrinsic value of Berkshire in 1965, we had a textile business. It was probably worth about $12 a share. But that was not the only part of the equation, because we intended to use any cash generated to try and buy into better businesses than we had, and we were fortunate enough to be able to buy in the insurance business in 1967 and build on that. So it was not only a combination of the business we had, but the skill with which retained earnings would be used that determined what the present value actually should have been at Berkshire going back that far. It's the same situation today. We will put to work billions and billions of dollars this year, next year, the year after. If we put that to work effectively, each dollar has a greater present value than a dollar has simply in cash or distributed. If we do it ineffectively, it has a value of something less. The businesses today, we have whatever the figure is in the annual report, roughly $80,000 in marketable securities. If our insurance business breaks even, that $80,000 is free to us in terms of using it. And we have a group of operating businesses, and we show their earnings in the report, and we're going to try and add to those, and they'll try to add to their earnings. But if Charlie and I were each right now to write down on a piece of paper what we think the intrinsic value of Berkshire is, our figures would not be the same. They'd be reasonably close.